Today we're going to be talking about putting together the simple Forex trading strategy for the big picture. Stay tuned, traders. This is a must watch. G'day traders, I'm Stacey Burke from Stacey Burke Trading. Today we're going to go through and put together everything for our simple strategy in detail. I'm going to break this down into some smaller videos. I've had a ton of emails, ton of questions. This week we've had massive movements in the markets the last few weeks. We're going to have that, I think, for the upcoming foreseeable future. There's going to be lots of volatility, lots of opportunity for us as traders. What I've done is I've broken things down into 8 areas. We'll probably have some sub areas in each one of these, but I'm going to do a basic short outline of every single area to try and break this down a bit further, make it simpler for everybody. And one of the areas that we haven't talked about yet that I'm going to go into a bit more depth today that will help explain some of the measured movements that we've talked about with profit taking, risk management, asymmetrical risk reward, a lot of the material that I've learned from Brandt and how I apply that to the intraday market. We're going to also talk a bit more in depth about the timings in relation to the high and the low of the day and our round number levels. Then we're going to talk about price action patterns that can confirm our thesis that the market is going to continue or reverse. Then also how to set measurements and gauge whether or not that opportunity gives us the reward to risk ratio that we want. So obviously if you're risking 25 pips and the target is only 25 pips, or the timings aren't matching up, then it's not worth the type of trade setup that we're going to look at. One of the things that I also learned from Peter was to target the best trade setups that we have had that show up in our patterns in the past and look for those to trade. Not trying to trade every single move in the market, but looking for the highest possibility setups that match our criteria, and then participating in those trades, managing our risk and targeting 4, 5, maybe 10 times our risk to reward, so that it makes it worth our while if we're going to put capital into the market. We're going to talk about trade management, and then we're also going to have a section on self-management, which again we've talked about this briefly, but about the live performance issues and why it's so critical to simplify everything down to the most easy, reproducible strategy that is robust enough, that repeats itself, so that we can duplicate that over and over and over again, and then scale it up in size. Get really good at executing your process, and then scale it up in size. So we're going to start off with the first part, which is applying classic charting principles. Now I've talked a lot about Brandt. I've chatted with Peter on the odd occasion just through Twitter and through messaging, but I've learned a massive amount from this gentleman. And if you haven't read Peter's books, I recommend getting Trading Commodity Futures with Classic Chart Patterns. I'll put the link below. I've basically chewed this book up, devoured everything I could learn from Peter. He's probably the most prominent expert in classical charting principles. And the basic patterns, I know Peter doesn't agree entirely with day trading or the patterns within day trading. He uses weekly charts for his analysis to pick the highest probability setups. But what I've gotten the most from Peter, risk reward, asymmetrical risk reward, but also these classic charting principles apply to our weekly charts. And these patterns show up over and over again. The 5 main reversal patterns: head and shoulders, tops and bottoms, rectangles, triangles, double bottoms, double tops. We're going to go through some examples of this today in this first part to show the power of applying the rest of our simple strategy to the bigger picture geometrical patterns that show up in our charts, and how we can look at our template and form a thesis each day for how the market sets up with our highs and lows at the market timings, at numbers, with price confirmation, to enter the market with asymmetrical risk reward, and possibly even participate in measured movements of these bigger geometrical patterns. So again, a lot of intraday patterns will fail, but generally speaking, if we're only looking to participate in a measured movement of that market in the right direction of that bigger geometrical pattern, that, as we've seen this week, can be a 300 pip move. So really important. If you haven't read Peter's stuff or follow him on his blog, do that. He's a master craftsman. And that is the third thing that I've learned from Peter, is to practice your process and master your craft. Really master your craft. Don't focus on the dollars and cents, but focus on being able to execute your trading process flawlessly. Your risk management, your targeting, your trade management, your profit targeting, and really refine those skills in live time and train yourself to be able to do that without hesitation or emotion or any of the other things that are going to interfere with you being able to execute and become consistently profitable at trading the Forex. So again, I'll put this link below, but in this book, Peter has all of his best dressed list patterns from the charts that he's traded, how those patterns were measured and executed, and these patterns again show up in our weekly 15-minute charts, whether you use hourly charts to mark off your levels or to draw your patterns. Really, it's irrelevant. The highs and the lows, the geometrical boundaries that form these patterns are present every single week, and they can be used to give us geometric measurements to trade within in our day-to-day trading, hopefully in the right direction. So obviously, if the market's going down, we want to be having a sell high setup. Doesn't mean we can't participate in both directions, but if we're trading counter trend, we want to know hypothetically where that trade may exhaust itself and where we may participate in a trade that could be in a potential measured movement for profit. So that's this area. We're going to go through some examples on the charts today. Again, the 5 main reversal patterns. There are multiple other minor patterns, but we'll focus on the bigger geometry just to give you some insight on how we can use the opening balance Monday, Tuesday, Friday, Monday, Tuesday ranges each week to extrapolate for measured movements if the market breaks those boundaries, or if they give us a pattern that completes for measured movements. So hopefully you're going to get an immense amount of value out of this. We're going to take it one step at a time. We're going to go through lots of examples on the charts so that hopefully everybody gets a thorough understanding that they can take this information and, number one, hopefully stay out of a lot of the garbage that traps traders into the middle of the highs and lows. We talk about trading inside of a box. If we can take trades, whether they're in this direction for a measured move, or if they're back in this direction for a stop hunt, or again another measured move, and vice versa, we're targeting, again, 3, 4, 5 times our risk, rather than chasing stuff with indicators that potentially, again, can scalp if you're making money using that. It doesn't matter. For myself, I'm interested in sitting outside of these ranges and targeting 5, 6, 7 times my risk at the right time when the market confirms that, and being able to enter the market, put my stop in, put my target in, or even possibly ride that target down for a measured movement. So again, we'll go through some examples of these main patterns, and again, I'll put the link for this book below. It's a PDF copy, and but Peter's other book, 21 Weeks of Commodity Trading, is invaluable. Those same principles apply on all time frames because the market is fractal. So stay disciplined, traders. You're going to get a ton of value out of this. Let's take a look at some examples now.
Okay, traders, just continuing our discussion in part 1 just regarding incorporating classical chart patterns in with our weekly and daily analysis. The reason that I think Peter's material is so invaluable, is he's had a huge impact on my trading, is the understanding of measured movements of these geometric ranges, whether we're trading intraday or we're combining multi-day analysis for geometric patterns that we can enter into with our intraday trading. it's important to grasp the concept of measured movements, and that's what gives us our asymmetrical risk reward, especially when we combined reliable patterns in terms of their geometry for giving us a bit more in-depth analysis in terms of which direction we want to be trading in. Classical charting principles do not represent the Holy Grail. It's vital to keep in mind that over 50% of chart formations fail to deliver, especially intraday, but they can also, in our analysis in the short term, give us a real high possibility indication of where the market may be moving to for a stop hunt or for a short-term completion of a move or pattern. It's really great, like when you grasp the concept of asymmetrical risk reward and then really focusing on staying outside of all the choppy movements and sticking to the bigger patterns, this can have a huge impact on your end result at the end of the day, at the end of the week, at the end of the month, etc. So I'll put the link below again for Peter's book. I think this, if you have any trading book ever, this is one that you want to definitely have in your library. So just looking at some of the shorter term patterns that do present, this is an intraday double top, and again it coincides with our levels at the market open. This is into the London Open at round numbers, and again I target 2 times that measurement as a profit target. And then heading into the US, as you can see, there was a double bottom 3-pin reversal at the US Open for almost 100 pips back up. But again, these patterns show up especially when we stick to the highs and the lows. This is an example of a pin hammer reversal. This is at a double top at round numbers. Again, 3 pins, double bottom at the US Open for the reversal back up. An example of a rising wedge into the close. This was this past week on the pound yen heading into, 2 weeks ago. But into the next day, again, the market in Asia breaks down and goes sideways. This earlier pattern gives us a thesis for a possible directional move down to complete that measured move target. Another example of a double top in a shorter term price reversal stop hunt into the US Open before reversing out of a symmetrical triangle false break initially into the US Open for a measured movement of that range up. This was in the pound yen. We talked about this earlier in a video on the daily chart, the possibility of that market moving down on the Friday. That market did move down, but then consolidated into the close and gapped on the open, which was a breakout of that rectangle from Friday. And then it completed a measured movement of that rectangle in the downward direction. Another example of a double top into the Asian close, dragging traders down low in London before coming back for the stop hunt to the high, and then completing one measured movement down of the double top distance. An example of a triple top last week in the pound yen to close out the session, and then going into a smaller rectangle for the breakout and reversal in the opposite direction. One thing Peter talks about in his book is that often a smaller pattern within a pattern will be the catalyst for a move to complete the bigger pattern. An example of a pennant formation, a continuation trade. So again, even if we come to the screen later in the session, our bias can be that we're looking for a sell high setup into that move down. As we head into the US session and the market has consolidated sideways, we can expect to see a possible stop hunt in the direction of traders who are short. An example of a Friday, Monday, Tuesday, 3 days of rise and then breaking that trend line. So again, we're not trading the break, but we're looking at the consolidation rectangle inside of the peak formation on a Wednesday for a straightaway measured move down, which completes 2 times the measured rectangle. An example of a Monday, Tuesday breakout that goes into a running wedge pattern that continues that move for a measured movement of Monday, Tuesday's range. Now that obviously didn't complete until the following week, but again, these geometric rectangles, or any range that you have a measurement of, usually Monday, Tuesday, Friday, Monday, Tuesday, will often give us a peak formation or a consolidation range for the continuation of a move, as we see, and then a smaller pattern that facilitates continuing that pattern completing itself. A bit of a messy head and shoulders, but we do have a peak formation head pattern that's gone vertical. These markets are unsustainable usually when they go in this aggressive nature. Drops down, breaks the neckline, and retests it before completing a full measured movement of the head distance. Another example of a double top where we have a peak formation come into play, consolidation, and then a breakdown. Market went sideways into Monday's range before dropping down below the full measured movement to continue and complete 2 full extensions of that upper range. Another example of a reverse head and shoulders. This is on a Wednesday, Thursday, Friday. So the market gave us our head and neck formation on the Thursday and then the reversal on Friday. Then we have a continuation Monday, Tuesday for a measured move of that pattern moving upwards. Another example of a Monday, Tuesday rectangle. So we have Monday's low, Tuesday's high. That's our opening range for the week. The market forms a small W pattern, layers on top on the Wednesday before breaking out, doing 1 full extension and then rising up to complete the 2 full extensions of Monday and Tuesday's original opening range. This week we had a descending triangle on the pound Canadian. So again, the measurement from the base point to the second point into the triangle, the market broke out, pulled back. We talked about markets doing 3 things: false break reversals, breakouts, filling more orders and continuing, or breakouts, reversals, and range-bound trading. This is an example of a breakout of the descending triangle, going sideways, extending that range out, pulling back, and then completing 2 full extensions of Monday, Tuesday's range. So again, if we have a larger geometric pattern in place, it helps us have a thesis of entering into the market. We may have missed a move or not had any significant opportunities to trade in the London session, but we come into the New York Open up high at the high of the day on a double top at round numbers with a pin hammer to enter into the market short, and then the continuation. Friday, same thing. The market auctions around before giving us a sell high setup either in London or into the US session. An example on the pound Swiss of a symmetrical triangle this week, continuing the move down. Again, market's been trending strongly down, somewhat of a rectangle formation dropping down and giving us a symmetrical triangle before breaking out on Tuesday, Wednesday to continue that move down. We had a triple top pattern present on the pound yen. Again, measuring from the high point, you could call this a double top. I call this a triple top with a retest, and then a full measured extension, and then the second extension down of that upper higher low. The pound gave us a combination of a symmetrical triangle / descending triangle. The market went vertical and gave us a peak formation. Some people might have even called this a head and shoulders, before breaking down Tuesday and consolidating into the point underneath of the breakout and breaking down again, retesting that trend line for a sell high setup either in early US or the US session, and then continuing that move down with a breakout pullback on Thursday and a small M pattern double top on Friday. So definitely worth stepping back each day, having a look at your week, Monday, Tuesday, Friday, Monday, Tuesday, if there's any larger geometric patterns in play that could be offering us a measured range to trade towards when we take our intraday trades either near the high or near the low for entering back into those moves towards those measured targets. So hopefully you got some value from today's video, traders. In our next video, we're going to be going a bit more in depth into the specific trades that we can participate in, whether we have a geometric range or not, and where we want to look at entering in and marking off our highs and lows, and how we can position ourselves, and where there's evidence that the market opens that there's a thesis for us to enter in at numbers with an asymmetrical risk reward opportunity. Stay disciplined, and we'll see you in the next video.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.